Hey, happy Tuesday, guys. Just kicking back here after the market has closed. It's been a huge day on the Aussie market. Virtually everything across the board has been higher, so it's going to entice a lot more investors back into the market. I think it's about the third or fourth day now. The ASX 200 has stayed above that 200 EMA on the daily chart, so we might see the market continue higher in the balance of October after a pretty weak September. Now, I want to talk about risk because I want to share with you a thought that I think will help you appreciate when the right time is to invest. Now, I want to preface this by saying that when I talk about shares, I'm talking about quality listed businesses. I'm not talking about penny dreadful stocks. I'm not talking about, and by the way, this little red mark here, I had one of those. Went to the skin specialist yesterday and he said I had to have something zapped off here, and it stung like crazy, but it's going to blister, I think. But that's what that little red mark is, so those of you wondering what that is. Quality listed businesses, not penny dreadfuls, not blue chip stocks, great quality businesses, solid financials, etc. That's what I'm talking about when I'm talking about buying listed businesses. Now, when is it riskier to buy those shares? Is it riskier when the market is falling sharply, or is it riskier when the market is rallying? I would suggest to you that if I asked the vast majority of investors, is it riskier when prices of these blue chip quality businesses are going down to buy them, or is it riskier when they've been rising and they're higher? I would say that the vast majority of mum and dad investors would say, oh no, it's much riskier when those quality shares are going down rather than when they're going up. When in actual fact, the opposite is true. When a great quality listed business is cheap, when the price has declined and the market is depressed, like it was back in March, the Aussie market rallied for a couple of months and is basically being going sideways recently until the federal budget. And there was a need now for money to come back in the market between now and the end of the year for many of these fund managers to actually get paid at the end of the year. Things like that will happen. They'll try and rally this market into the end of the year so they can get their bonuses, etc. In fact, tomorrow night in our live training for our clients, I'm going to be talking about specifically stock options that management get in listed businesses and why you must understand how that works. But the bottom line is this: it is less risky to buy a great quality business when the market is depressed, and it's more risky to buy a business when the market is excited. People want to have their thoughts justified and they want to buy when markets are rising because they feel more comfortable. But there is more risk in buying a rising market over time than there is buying a depressed market of great quality listed businesses, simply because the margin for safety is more significant when the market is depressed, meaning the probability of it consistently going further down. Now, this comes back to needing and wanting and understanding how to read a financial balance sheet with a listed business. If you don't understand how to read listed businesses' balance sheets and financials to understand if they're financially sound, then you shouldn't be investing in the market. But once you do that, and there are many businesses in 2020 that have been out of the favor with the market, very depressed with their share prices, and the risk is actually lower now than what it will be in 2 years' time when the share prices are higher. But so many people around the world will wait for the share prices to be higher because they want to feel comfortable that the market is recovering before they buy. It's too late. And the risk is higher because the next time the market dives, it's diving from a higher level than where it is right now. So it's very important to understand that, where that risk element lies. And here at Trading Mastery, I'm always giving our clients an understanding of these important things. And as I said, tomorrow night in our live training, every Wednesday night, we have 90 minutes of live training. I'm going to be interviewing the former Chief Operating Officer for Barclays Bank a number of years ago. He's worked at Citigroup. He's worked at a number of big banks around the world. I'm going to be interviewing him about the banking industry right now. He's the chairman of Trading Mastery. And we're going to be talking about why banks are cheap, when are they likely to rise in value, when are they likely to earn more profit, and to give them insight into the credit risk that is going on at the moment to help our investors understand, is now a good time to invest? Should we wait a little bit longer? All of those important things. Remember, when a good quality listed business is depressed, the risk is lower than when it is when it's higher. Have a good day, guys. Any questions, comments you've got for me about anything to do with the financial markets, I'm here to help. Put your comments in the comment section below, and I wish you every success. Wasn't it a great day for us at Trading Mastery today? Everything across the board was up. Not like that every day, but we'll take it when it is.